Our next session is the future of emerging markets. So we're looking far beyond London. Some of the most interesting growth and technology adoption curves are in Africa, MENA, CE, other emerging ecosystems, but so are some of the sharpest risks. So the question for this panel is really where the real venture returns are likely to come from, how to think and underwrite those currency, political and regulatory risks intelligently, and what it takes for founders in those markets to become investable for global capital based here in London and parts near here. So we've brought together today investors and operators who are deploying across Africa, CE and beyond, and who see both the opportunity and the constraints up close. And to lead that panel, we have Chanelle Denton, who's a senior account director at Wimbart, who's a senior communications advisor, and she specializes in African and emerging market tech companies, helping founders tell their credible stories to global investors and stakeholders. Over to you, Chanelle.
I think, first of all, it would be great to just have the panel introduce themselves. So we'll start with Benjamin.
Thank you. I'm Ben, and I'm a principal at Boost Capital Partners. We're a London-based fund, but we invest across Europe, the US, and LATAM. So we see a lot of different markets and the difference between them. Before that, I grew up in Mexico, and I was a lawyer and an investor in Mexico as well.
Hi, my name is Uwem. I'm the head of investment at Launch Africa Ventures. We are an early-stage Pan-African VC fund investing across various sectors, particularly in high-potential founders building scalable businesses across the continent.
Hi, this is Cenk Bayrakdar, the managing director of Revo Capital. We are currently investing from our third fund. We have raised $250 million so far, and we also run a co-investment vehicle for IFC. Usually our ticket sizes are $3 to $5 million, and we are an early stage investor in the ecosystem.
Okay, thank you. So I'm going to be pointing some questions, obviously, at the panel, but do feel free, once we get to the end, to ask any questions, because we do want to have this as a very sort of engaging debate. All right, so to all, emerging market VC has been through a brutal correction since 2022. Are we at the bottom, in recovery, or still working through the consequences of that previous excess? Benjamin?
I would say all of VC went through that, not only emerging markets. Like we raised our funds one in 2022/2023, and even here in London, it was probably one of the worst times in history to raise a venture capital fund. We are seeing a bit more optimism in the market, but both emerging markets and established markets have the same problem, which is liquidity. So I would say that liquidity problem hasn't been solved, at least in LATAM, which is the sort of emerging market that we look at besides the rest. The liquidity problem is big because there's a not very developed capital market. So most of the exits are M&A based, and what we see from LPs is, I invested in a fund 5 years ago, I haven't seen a single dollar back. So why would I invest in any new funds? So I would say it's probably not over yet.
Totally aligned with what he's saying. All across the world, VC is taking a beating, except you're investing in AI in the US anyways. But for Africa particularly, which is my focus, we're at the bottom of the cycle. But I think that it is good, because then you have leaner companies, you have companies that are building for the needs of the market, companies that are not just blitzscaling for the sake of it, and more efficient companies. So yes, we're at the bottom of the cycle, but what happens after the bottom of the cycle? There is that growth and that uptick. And yes, we are hopeful that we've bottomed out and it's time for us to grow. I think generally the problem is when you look at emerging markets, the question of what type of vehicle or what kind of investment is best for the market then oftentimes comes up because everybody's saying liquidity, no liquidity. But the mistake that I don't want us to make is when we're looking at how well the situation is evolving, that the expectations of returns from emerging markets should be reduced compared to other advanced markets. And I think that I've been seeing that conversation happen over and over again. Reality is nobody's going to deploy capital into any market that they don't expect more, at least 3x. So if you say we've bottomed out, and because we've bottomed out, in an emerging market, the expectation returns should be slightly different, I think it's the wrong way to go. I think eventually everybody is going to expect returns at whatever multiple they are looking for it. And we need to work with what we have to ensure that those returns and that liquidity begins to happen.
I totally agree. Like every market, I think, had the side effects of this, inflation just going up and governments trying to seize that, and we had the after effects of that. However, 2025, especially in Turkey, we had seen recoveries of the whole thing, and we had seen some good large rounds happening, so that we could do some good DPIs, and then the 2026 did not start well, and because of the oil prices, we believe that the next quarters, especially a full year or so, will be high inflation rate all over also the developed markets, and this after effects of the will be much higher for emerging markets. So I don't feel that we will see some good venture capital environment for the whole year or so ahead. So the recovery will be, I think, longer than we anticipate.
And just on that, would you say that in emerging markets, going in as a VC with the philosophy of patient capital is more sustainable in those markets? Anybody?
Okay. I feel like one thing about emerging markets, I think we learn to live with inflation a lot better than the developed markets. So inflation, for example, currently in Turkey, inflation is around 30 to 40%. And this is a fact, so you need to learn to live with it. Yeah. That's why gross profit margins is a major focus area for the founders. Liquidity is a major focus area. Keeping the team leaner is a major focus area. This is something that we are not learning since 2020. This is something that we had to learn in order to survive. So if you are investing in emerging markets, I think the quality of the team and the experience of the team is very, very crucial. And you need a team that has some experience towards all this. It's not like you raise a huge amount of money, you go out and spending it, which may be the case, which had been the case in more developed markets. But in emerging markets, we see that we see that the founders try to keep the cash runway a lot longer than we see in other markets, really.
Yeah, just to contribute to that, particularly for the African continent, I think one of our major problems is that we've tried to, and I sort of made this joke in Tunis some days back, we try to VCify everything. We're trying to force fit everybody into the VC vehicle, when in reality what we need is a plethora and alternative, different capitals to fit the different growth cycles of the company or the businesses that we're interested in investing in. And that's where concessional finance, blended finance then comes in. And I gave an analogy. Usually concessional funding comes in to build the runway, while VC comes in as the aircraft to land, right? There has to be that investment in infrastructure. And unfortunately, we're trying to use VC to do everything. And that leads to some incompatibilities with expectations for returns, length of the fund cycle, and the kind of businesses that eventually we invest in. But no matter the case, and something I mentioned earlier, I think that even though we have to deal with what we have, like you said, lean teams, the kind of business we're investing in are slightly different based off the reality of the market. We cannot tamper with the return expectations of the LPs, or else they're going to put it in less risky ventures outside these emerging markets. So we have to use what we have to return money to the LPs either ways. And that is the work that we sleep, breathe, and live every day as we invest on the African continent. But just to sum up everything I've said, we do need other sources of funding on the continent, and everything is not VC. Everything should not be VC, and we should stop force-feeding it.
Okay, thank you. All right, well, this is also pointed at you, Uwem. After the correction, which portfolio companies have strengthened their positions? And what does that tell you about what survives in African tech versus what was propped up by cheap capital?
Now, you're asking me to mention my favorite baby, but that is difficult. I would say what I've seen is the businesses that built out a moat of the quality of the data layer that they had built over time were the ones that survived or have survived, and not necessarily building their businesses on distribution layers that were Western built. So imagine somebody building a business of, for lack of a better example, a Facebook marketplace. This is just a left field example. And so what we've seen is businesses that really harnessed behavioral data, consumer data, were building infrastructures that other businesses could actually leverage on, are the ones that are doing quite well. One of our top performing companies looked at the remittance landscape and said, hey, we have lots of immigrants, Nigerian immigrants particularly, moving to various parts of the world. However, when they land in those countries, they have no credit score. And what did he do? He said, what's the alternative way to build a credit profile for these folks? How about we build that using the remittances that they send back home? How many of you have heard of black tax? Right? People always send money back home for different reasons. So how about you use that to build a credit profile? And in 24 months, they went from 50K ARR to, we're talking 60 million ARR. And MoneyGram is already leveraging their stablecoin infrastructure to enable people send money back home. Now, this is something that this is a solution that was in everybody's face, but nobody thought about it in the way they thought about it. So they harnessed the data, the behavioral data of people, then they upsold different products and services from mortgage to all the likes to enable people, to enable the product be sticky. So in the end, people that figure out how to make their product sticky based off their own localized data sets are the ones that are thriving at the moment.
Okay, thanks for that. Over to you, Benjamin. What is your framework for deciding which emerging markets justify the complexity of FX risk, regulation, and exit uncertainty, and which ones you walk away from?
We're very practical about this. We basically go into markets that we know, because I think more than the complexity on like FX risk and even exits, etc., it's the complexity of the market itself, like understanding what people will use in case of like a consumer company, or how the financial system works in a specific market, etc., etc. So what we do is we looked at the globe or the global map, and we said, what do we understand? Part of our team is European, so and we're based in London, so we can operate here, and that includes Eastern Europe if we count that as a sort of more emerging market. We understand the US, and we spend a lot of time in San Francisco, in New York. We can invest there. And I'm from Mexico. Some of our team is from LATAM as well. We understand that. So for us, it was a matter of which cultures, which systems do we understand, and that's how we pick where we invest. Then within those markets, country by country, it varies a lot. So there are some countries with higher political risk where we unfortunately cannot invest. Or there are big markets, for example, in LATAM you have Brazil, which is a great market, it's massive. But if you don't have boots on the ground, if you don't have even a fund like that is legally based there, it's very complex. One, because there's very good funds, so the competition is actually like very tough. And two, because the tax system is very hard when you're investing from outside. So even in LATAM, we have to exclude a couple of countries, but it depends like case by case on whether it makes sense for us or not.
Yeah, and I guess that's kind of the overarching theme. It's understanding the market context. So it's not just about the sectors necessarily, but that market context as well. Okay, Cenk, and what is the investment case for Turkish tech in 2026? And how do you address the macro and currency concerns that have kept many international VCs on the sidelines?
For Revo, we are a VC. We are like, unlike most VCs, we are not financial guys. We used to be, I used to be the chief information officer and chief product officer for Turkcell, which is the largest telco there, for over 13 years. So we are product guys. We launch many, many products. So we help the guys in many other ways than just giving money. So one thing we do is we try to get the best of both worlds, meaning that, for example, we make sure that we invest in a global product. So we make sure that product is not just for Turkey. We take the founders and the marketing and sales to either US, mainly US, and sometimes UK. And we make sure that we do a flip. The IPs are in these countries. This is mainly trying to see what a foreign investor is going to look for when investing into the company. So this is like a long list for us. So, but we always keep the R&Ds in Turkey. The reason for that is there are huge incentives in Turkey for R&D personnel. For example, there are 100 technoparks, and if your company has the R&D in technopark, you don't pay any corporate income tax. You don't pay any personal income tax if you work there. So your gross is your net. And the company doesn't pay VAT. So when doing sales all over the world. So these are like second to none. So these are great incentives. So we are trying to make sure that the company gets the good talent in such a taxless environment, and with that strength makes the runway even longer. So, so having the global product kind of makes sure that there's hard currency, so you don't just earn Turkish lira, and having this infrastructure kind of with a geographical backup, I think kind of makes the best of Turkey, and also makes it a global company. So there are many companies that you wouldn't recognize as a Turkish company, and however, the whole R&D is in Turkey. We are the backers of, for example, Getir, which was also working here. We are the fortunate VC that sold half of their shares at the decacorn levels. So Getir had some troubles later on. We are currently the investors of Midas, which is the fintech which has done the largest round in Turkey last year or so. So we are the first investors of many of these companies. For example, Massive Bio, which is a cancer pharma clinical trial company in US. It's a New York company, but the whole R&D is in Turkey. For example, UK company Bumper, the whole R&D is in Turkey. So like many, we are the first investors of these companies and trying to make them even stronger with the good talent in Turkey and this taxless environment.
That's quite an interesting model. Would you say that we're seeing anything quite like that in the African or Latin market?
Given the regulatory friction and because we invest for scale in the end, One of the best ways we do that is to ensure that we are investing in the holding company structure, which is oftentimes, and where the IP sits, which is oftentimes in Delaware, Singapore, the UK, in any investor-friendly jurisdiction, because obviously double taxation and the likes. But our focus, again, is to build African continental champions for the world. So eventually you have lots of companies start on the continent and expand towards markets outside the continent. And there are many African startups in that space that are doing that. And even if you go back in time, you find out that there were lots of global companies where the initial idea actually started in Africa. Pre-Uber, there was a company called Zimride. How many of you knew that the idea behind Uber actually started in Zimbabwe? Most people don't know. So, point is, there's lots of innovation on the continent that have global potential. Our job is to find those businesses, help them scale, and help them find that international market they're looking for. And that's why we oftentimes invest in the holding structure that owns all the IP, so that scaling becomes less of a friction and more of an advantage when we start to enable them grow towards the markets that are more beneficial for their growth.
Yeah. Benjamin?
We wouldn't invest in a company that is incorporated in a country in LATAM. It's usually in US Corp. One of the big reasons is we don't want to take a flight to visit a notary public to sign a round and back. It would be very tiring. But it's also a matter of protection and tax. And the good thing about LATAM being so close to the US is you have a very clear path towards, I don't know, you start in Colombia or you start in Chile and you go up and you go to Mexico and you build in that market and then you go and raise your Series A, Series B in the US and you keep going. So usually you have to make it attractive for foreign funds or US funds as well in terms of structure. And like us, they wouldn't invest unless it's a Delaware corp or a US corp. Yeah.
Okay. So just on this as well, obviously you're doing it successfully, but what are the frictions to actually taking some of these locally built companies more global?
Very good question there. I think that there are many reasons. One is, and if I'm going to be very honest, our storytelling needs a lot of work. We don't talk enough about all the great innovation and the great technologies that come from the continent. And if you're not talking about all the good things, people are going to pick on the negatives. So I've had situations where we're bringing investors to, say, in Lagos or in Nairobi, and I'm hearing things about, I heard they kidnap people in Lagos. I'm like, what? We live in Lagos. We do business in Lagos. Paystack, which was acquired by Stripe, started in Lagos. So where do you hear all these things? So our storytelling we need to do better work of talking about the companies that are hugely impactful. 2, we need to, so I've talked about storytelling, we need to also invest in the right companies. And I say this very carefully, because what exactly makes a right company? But we need to ask ourselves the question, where is the world right now? Where is the focus right now? AI-enabled companies, right. Where can these AI-enabled companies play the best role on the continent? What problems can they solve that are critical on the continent? And how can we invest in that cycle? Because most investors will invest in things that they are comfortable with, what they've seen their peers invest in, and they understand, right? So if the world right now, for particularly, let's say the US investors are focused on AI, how then can we show them that those opportunities exist on the continent? By correctly identifying the deal flow for them, not waiting for them to come look for the deal flow. We have a lot of work to do in emerging markets of showcasing the companies that are building the best products and are scaling appropriately, than waiting for them to come do the work, because we should be the ones spotlighting them and investing first, rather than waiting for them to do the work for us. And then I think, finally, And I sort of touched on that. We need to find the appropriate capital for the various stages of growth for these businesses. It could be revenue-based financing, it could be whatever format, it could be a type of debt, but we should stop assuming and force-feeding companies that don't need VC capital to take on VC capital. Not everybody is supposed to have venture-style growth. So let's fix that problem of trying to force-fit everybody to bleed scale, to have venture-style growth when ideally that type of capital is not suitable for them.
Anything to add?
I think, like talking about friction to building global companies from emerging markets, I think, sadly enough, it's a matter of ambition from founders as well in many cases. I love going to SF because you go there and you speak to someone and they're building an agentic layer for walking your dog, and they think that they're going to change the world. That is hard to see sometimes in emerging markets. Like it's very localized. It's great because they want to create an impact where they live, but it's harder to convince them to build something global. And that's not necessarily a bad thing. Like you can build, Nubank is only in LATAM, like Kavak, and there's many unicorns built in their specific markets. But the ambition from founders to build global companies a lot of times is lacking. And you see that even in other markets, like you see that in Europe as well. If you go to Spain or you go to France, most people build for Europe. They a lot of times don't have a global vision. So I think if you have an ambitious founder that wants to build a global company, you can find it everywhere. But you have a higher concentration of those type of founders in some markets than in others.
I kind of disagree slightly. The ambition is, there's lots of ambition on the African continent. Obviously, you have 54 countries, 54 cultures, but that ambition, it exists almost everywhere, almost. Let me not generalize too much. The problem, though, is what they see as scale or as that global play oftentimes might not be necessarily the right direction for what they're building or how they see themselves expanding, and that's the work of the investor and somebody more experienced to tell them, how about you start here, go vertically than thinking of growing horizontally and scaling outside the market. But one final point that I missed out on was capital flows where there is more capital. So there's lots of money invested in fintech on the continent because that's where most of the liquidity has come from. So we need more local capital actually investing on the continent. Obviously, it behooves us the responsibility to also communicate what the VC asset class is to some of the HNIs, the pension funds, and the likes. But we need more capital play. We need the financial markets on the continent being more robust and invested in local technologies, because that's the only way that foreign investors will look at the continent and say, maybe this is where I should be pouring more of my allocation into.
Yeah. Okay, so we're going to wrap up now with one question on one concrete prediction about emerging tech that you think will be a structural shift in 2028.
Like I have two, one for Turkey and one for more global. For Turkey, I think if some of you guys are covering Turkey and also emerging markets, you would know that Turkey is very well known for gaming. So it's a vertical that Istanbul is the second capital for gaming and after London in Europe. So I think by 2028, Turkish founders and Turkish diaspora will also be recognized for definitely AI native SaaS verticals. So, and there's a huge change there, and we see that the work that's coming over. The second one, which is more global, and this is probably not 2028, but 2030 and onwards, when you look at the top 10 SaaS companies at the moment, I don't think, probably we will lose 3 or 4 of those, either by consolidation or maybe taken over. So that list is going to change drastically by 2030.
Interesting.
I have lots of predictions, but I'll pick one. I think that we're going to have lots of global players acquire companies from the continent, and that's because as more and more AI companies have been built and more companies have built their businesses, they've kind of ignored emerging markets in Africa in particular. And as such, they've actually ignored one of the most diverse continents in terms of people, in terms of culture, in terms of language, in terms of health. And what we're seeing is we're beginning to see global players knock on the door and say, hey, we know as we built up skill, we sort of missed out on this middle. So say, for example, we have a portfolio company that targets neurological illnesses. And all of a sudden, a company in the Middle East is saying, if you can scale to a certain level, we can acquire you. Also, Mayo Clinic is also looking at them. And that's because there's a diversity in the data that they've gotten from the continent. So my prediction is we're going to see much more, not just investment, but much more acquisition from global players on companies that have built a data moat on the continent.
Interesting. Benjamin?
2028. I hope we're not talking about AI all the time by 2028 still. I would say Latin, but also globally, health is a sector that will keep growing a lot. I was in another panel yesterday with the Royal College of Psychiatry, and it's very clear that there's a crisis in the health system. Workforce, financial, like the cost is increasing a lot. Where we meet the patients, people are chronically online now, so I would look into those problems to find companies building for that, and into data gaps. Women's health is the most obvious one. Like, we don't have enough data on that. So I think it's more of a global prediction, but yeah.
Okay, right, thank you. So we didn't have time for questions after all, but I think I think the panel did a fantastic job. So if you don't mind giving them a round of applause.